You're listening to HECM World Weekly, the nation's only weekly podcast bringing reverse mortgage news to you, the mortgage professional. There are reverse mortgage calculators, but then there are reverse mortgage point-of-sale solutions. Lenderful Solutions helps you get more loans, retain more customers, and even make online applications a reality. To learn more, visit lenderfulsolutions.com.
Hi, everyone. I'm Gabrielle Hayen, and welcome to another HECM World Weekly. Every week, we look beyond the headlines to explore the trends shaping the reverse mortgage industry and the retirement landscape more broadly. This week, there were plenty of interesting stories. HUD is considering changes that could make reverse mortgages more accessible. Mortgage companies make innovative new moves. A controversial new study has reignited debate about what's really been driving America's housing market. And perhaps the most incredible story of all comes out of San Francisco, where artificial intelligence is helping fuel one of the most extraordinary luxury housing booms the city has ever seen. The common thread running through all of it? You guessed it, housing wealth. More specifically, how housing wealth is becoming one of the defining financial assets of retirement. Let's get into it. Our first story comes directly from the reverse mortgage industry. NRMLA has formally called on the U.S. Department of Housing and Urban Development to modernize its minimum property requirements. Now, that might sound like a technical policy discussion, but it has very real implications for borrowers. NRMLA argues that some of HUD's property standards were developed decades ago and simply don't reflect today's housing stock. As a result, borrowers, particularly seniors living in older but well-maintained homes, can face unnecessary repairs, added costs, and delays before qualifying for an FHA-insured reverse mortgage. For many homeowners living on fixed incomes, that friction can become a significant barrier. What's encouraging is that HUD is actively seeking feedback. If some of these recommendations are ultimately adopted, it could streamline the lending process while maintaining the consumer protections that have long underpinned the HECM program. For reverse mortgage professionals, it's another reminder that the industry continues to evolve. As America's housing stock ages alongside its population, regulation also needs to evolve. Innovation was another major theme this week. Finance of America announced that its HomeSafe Second reverse mortgage is expanding into 4 more markets, bringing availability to 18 states plus Washington, D.C. The timing is no coincidence. Millions of homeowners remain locked into ultra-low mortgage rates secured during the pandemic. They may want to access their equity, but they certainly don't want to refinance in today's much higher interest rates. Products like HomeSafe Second allow qualifying homeowners to tap into that equity without disturbing their existing first mortgage. That's a trend we're likely to see continue. Meanwhile, Atlantic Home Mortgage launched an AI-powered refinance platform called LendTrain. What's interesting isn't simply the artificial intelligence. It's the fact that licensed mortgage professionals remain at the center of the process. The technology helps educate borrowers and improve efficiency, but people still provide the advice. That's a good reminder for our industry. AI will almost certainly change how we work, but trust, experience, and good judgment remain very human qualities. Realtor.com also released its updated mid-year housing forecast this week. The biggest change? Home prices are now expected to increase by just 1.2% this year. That's roughly half the original forecast. Mortgage rates are still expected to average around 6.3%, while existing home sales are forecast to improve only modestly. On the surface, slower home price growth might sound like bad news, but the bigger story is actually one of normalization. Household income continues growing, affordability is expected to improve slightly, and monthly mortgage payments are forecast to ease. After several years of extraordinary volatility, the market appears to be settling into something much more sustainable. And for reverse mortgage professionals, this changes very little. Most HECM borrowers have accumulated equity over many, many years, often decades. And whether prices grow by 1% or 5%, this year doesn't fundamentally change the enormous amount of housing wealth many older homeowners already possess. If anything, slower appreciation often shifts the conversation from waiting for future gains towards making better use of the wealth that's already there. One of this week's most discussed reports came from the Federal Reserve Bank of Dallas. A new working paper concluded that the surge in unauthorized immigration between 2021 and 2024 materially increased housing demand across the United States. According to the economists, that additional demand contributing to home prices rising by around 6.6% and rents by 4.3% during the study period. These findings quickly became part of the political conversation. But regardless of where people sit politically, the research reinforces an important housing principle. Demand drives markets. And whether that demand comes from immigration, population growth, domestic migration, or household formation, supply has struggled to keep pace for much of the past decade. For reverse mortgage professionals, that's another reminder that America's long-term home equity story continues to be supported by structural housing shortages that extend well beyond interest rates or economic cycles. Now to perhaps the most remarkable housing story of the week. If you think all housing markets are behaving the same, San Francisco would like a word. According to New Compass research, 144 homes sold for at least $1 million above their asking price during the first 6 months of this year. Just 1 year ago, that number was only 8. One home, listed for just under $8 million, ended up selling for $15 million, and another home doubled its asking price. Compass says it hasn't seen anything like it in more than 2 decades of analyzing housing data. Much of that momentum is being attributed to the enormous wealth flowing through the technology sector as artificial intelligence continues transforming Silicon Valley. Record highs across the stock market have created fresh waves of wealth for employees at companies like NVIDIA, Meta, Apple, and Google, and much of that money is now flowing straight into real estate. Why does that matter for our industry? Well, it reinforces something that we've spoken about before. There is no single U.S. housing market anymore. Some markets are cooling, while others are booming, and in affluent technology hubs, housing wealth continues growing at an extraordinary pace. For reverse mortgage professionals operating in high-value markets, that creates increasingly sophisticated conversations around retirement planning, tax efficiency, and housing wealth. One story challenged a narrative we've heard repeatedly over the past few years. According to new mortgage data, millennials and Generation Z accounted for around 65% of purchase mortgage rate locks during the second quarter. Despite affordability challenges, younger Americans are still finding ways into the housing market. Many are receiving financial assistance from family members to help fund their deposits. Meanwhile, older homeowners continue staying put. The so-called mortgage lock-in effect remains powerful, with many homeowners reluctant to trade their 2 or 3% mortgage for today's 6% rates. For reverse mortgage professionals, this creates 2 interesting dynamics. First, aging in place continues becoming the preferred option for many older homeowners. And second, family conversations around housing wealth are becoming increasingly important. Helping children into the market, planning inheritances, and housing equity strategy are all becoming part of broader retirement discussions. There is one final story that particularly caught our attention. President Donald Trump this week publicly praised Australia's compulsory superannuation system and suggested the administration is looking closely at whether elements of that model could work in the United States. Australia's retirement system requires employers to contribute a percentage of wages into retirement savings accounts throughout a worker's career. While the 2 countries have very different retirement systems, the broader message is clear. Governments everywhere are looking for ways to improve retirement security as populations age and pressure grows on public pension systems. Whatever reforms eventually emerge, one thing appears increasingly certain: savings, investments, Social Security, and increasingly, housing wealth. This week's stories weren't really about policy changes, AI, or even home prices. They were about the evolution of housing wealth. Across America, housing is becoming far more than simply somewhere people live. It's becoming one of the country's most important retirement assets. As that evolution continues, the role of reverse mortgage professionals becomes even more significant, not simply as loan originators, but as trusted advisors, helping older homeowners understand one of the largest financial assets they'll ever own. And judging by this week's headlines, that's a conversation that's only becoming more and more important. Thanks for joining us for another HECM World Weekly. If you enjoyed today's episode, please subscribe wherever you listen to podcasts. And don't forget to visit HECMWorld.com for the latest news, analysis, and insights from across the reverse mortgage industry. I'm Gabrielle Hayen, and we'll see you next week.